Despite the market constantly hitting new all-time highs in 2024, we still have multiple dividend stocks that are trading right at their 52-week low, and one of those dividend stocks is actually a pretty popular one. We have McDonald's Corporation, stock ticker MCD, trading at $250.49 per share, and if we come over here, we can see that 52-week low is about $243.50 per share, so it's very close to that 52-week low. If we look at them over the past year, they're down by about 16.53%, and if we look at them year to date, down by about 15.52%. So what I want to address, why has this stock fallen so much? This is a company that historically speaking, people have considered pretty great. So I want to go ahead and jump straight into it. If we jump over to my profitability spreadsheet, a lot of the story with McDonald's can be told here. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But let's go ahead and come up here and plug in MCD and hit enter. And you can see all this data is going to automatically load in. Now, what I want to focus on right now is revenue versus our cost of revenue. First off, we can see 2013. Revenue was around $28 billion, but we can see this was declining until 2020. Then we've started to see an uptick again over the past few years. So why has revenue not really grown any since 2013? That seems like a pretty big concern. And if we come over here, we can see the 10-year revenue compounded annual growth rate is about -1%. So what's going on here? Well, I'm about to answer that, but I got to point something else out first. If we look at the gross profit ratio over the past decade, we can see this has taken a massive jump up. And in 2013, it was sitting at about 38 to 39%. And if we look at where it was in 2022, 57%, and in 2023, 55.62%. So we've seen massive increases in the gross profit ratio. So the end result of really good increases in the gross profit ratio is even though they had declining revenue, we can still see earnings per share has grown pretty significantly during this time. So why is this? What is going on here? Well, one of the things we have to understand about McDonald's is how their percent of franchised restaurants has changed over the past decade. We can see in 2014, it was sitting at about 81.5%, but 2023, it finished at 95%. Now, you may be thinking, how is this relevant to what we were just talking about? Well, you have to understand how McDonald's makes money. On McDonald's investors presentation, there is a clear graphic that does a great job of breaking down exactly how they make money. We can see it showing us the revenues from rent, royalties, and initial fees and profits from directly operating restaurants. But what we'll see is only around 5% of McDonald's restaurants are actually directly owned by McDonald's. So what does that mean? Well, in that scenario, McDonald's is responsible for all the equipment, the building, and the real estate from an investment standpoint, but they get all of the operating profits. But again, this is only for 5% of their restaurants. If we look at foreign affiliated restaurants, which is around 20% of their restaurants, we can see McDonald's is not responsible for any of the equipment, the building, or the real estate. But what they do get from this scenario is going to be royalties and equity in earnings. We can see 20% of restaurants have developmental licenses. Again, McDonald's is not responsible for equipment, building, or the real estate, and they do get to collect royalties in this scenario. And then we have the conventional license, which is around 55% of their restaurants. And in this scenario, they don't provide the equipment, but McDonald's will pay up front for the building and the real estate, and in exchange, they get rent and royalties. So the huge reason we've seen such changes in the revenue over the past decade and in the gross margins is going to be because the company has started focusing on the percentage of franchised restaurants. This is what's led to much better gross profit ratios. So this has clearly been a strategic move by the company over the past decade. Now, with that being said, the company is still pretty close to their 52-week low. So what's going on? Well, one of the things we can see in their most recent earnings report, which was a couple of months ago, we can say they saw misses on the earnings per share estimates, but a slight beat on revenue. But if we look at the upcoming quarter's earnings, which is going to be announced 7/29/2024 in pre-market, if we look at the earnings per share revisions over the last 90 days, we have 0 bullish revisions and 26 bearish revisions. So sentiment around this stock is not looking too good right now. Why is that? Well, if we look at the recent quarter's earnings report, there's a couple of things that we can point out. First off, global comparable sales have grown by about 2% for the quarter, which was 13 consecutive quarters of positive comparable sales growth, which I guess is good. Consolidated revenues for the quarter were more than $6 billion, which is good as well, but these are just the headline results. If we dig into the actual earnings call a little bit more, we're going to start to see some of the problems. We can see McDonald's is dealing with slowing sales. One of the things they mentioned is inflation-wary customers are eating out less often in many big markets. In the first quarter, fast food traffic was flat or down in the US, Australia, Canada, Japan. the United Kingdom, and Germany. And one of the things the CEO of McDonald's stated is the consumer is certainly being very discriminating in how they spend their dollar. We can see it may be more pronounced with lower income consumers, but it's important to recognize that all income cohorts are seeking value. So really the economy we're operating under is really hurting McDonald's right now for pretty much people of all income levels. Now, from a future growth standpoint, I dug into one of their annual documents, and here's one of the things I found. They have plans to increase their global footprint to 50,000 restaurants by 2027, which they believe will help solidify their position as a leader among global consumer brands. But here's what I think is even more interesting. Down here they state, right now, we're on track to expand from 150 million to 250 million active loyalty users within the next 4 years. And the goal behind this is to enhance the digital transactions and loyalty program. Now, the digital transactions and loyalty program is nothing new for McDonald's, but I don't think it's reached its full potential. Think of companies like Starbucks. This is huge for them, and I think McDonald's realizes there is opportunity here. This is also a great way to start getting more traffic back into their stores. Another one of the keys that I pointed out in the recent earnings report is same-store sales rose 2.5% in the first quarter, but this was actually largely due to price hikes carried over from the last year. Now, like we all know, inflation has been pretty tough, especially in the last 2 to 3 years. And if we look at the past decade, actual inflation is estimated to be around 31%. Is that actually right? Well, that's a debate for another day, but what we can see is McDonald's prices have risen higher than any other fast food joint during this time period. They've pretty much doubled their prices since 2014. It's increased by 100%, while comparable companies like Taco Bell up by about 81%. We can see companies like Wendy's 55% and Starbucks by about 39%. So yes, sales have increased, but that is due to price hikes. Now, historically speaking, McDonald's has been considered a pretty great dividend stock. So let's go ahead and look at them from a dividend perspective. Again, jump over to my dividend breakdown sheet, plug in MCD, and hit enter. And this data will automatically load in. Now, one of the things we can see is the starting dividend yield for McDonald's sitting at about 2.67%, and we can see the dividend growth rates over the past 5 and 10 years, both pretty decent at around 7%. So decent starting dividend yield and decent dividend growth over the past decade. We can see they've gone from around $3.12 per share in 2013 all the way up to $6.23 in 2023, and right now the dividend payout is about $6.68. We can see that free cash flow payout ratio is sitting at about 62.48%, which eats up a decent bit of their free cash flow, but they still have some room left over to reinvest back into the business. Now, we can see 5-year free cash flow CAGR has actually been pretty good at about 11.42%. I'm pretty happy with that growth rate from the free cash flow for this company. So we can see 2013 free cash flow sitting at about $4.3 billion, while the dividends paid out sitting at about $3.1 billion. So at that time period, free cash flow payout ratio was actually pretty high, sitting at about 72.5%. We can see in 2017 it got as high as about 83.5%. So it's actually come down a little bit over the past few years, which is something I like to see, with 2023 free cash flow sitting at about $7.25 billion and dividends paid out by about $4.5 billion. So I think free cash flow, especially compared to where it has been historically, is sitting in a pretty decent place. If we jump over to my stock screener, we can look at some key metrics for McDonald's. We'll plug in MCD and the data will load in. Now, one of the things that I personally notice immediately is revenue per share. Now, why is this interesting? Well, like we saw on the profitability spreadsheet, revenue declined pretty significantly from 2013 to 2020, and then we've started to see a recovery. But if we look at revenue per share, we can actually see this hasn't been the case. It's remained pretty steady and then started increasing in 2021, 22, and 2023 up to $35.02 per share. So why has revenue per share increased when revenues remain stagnant or even decreased? And the reason behind this is they've performed a lot of share buybacks over the past decade. Look at McDonald's in 2013. Shares outstanding was close to 1 billion. But if you look at 2023, shares outstanding was all the way down to around 728 million. So they've bought back almost 25% of their shares over the past decade. It's a great way to reward shareholders and boost all those per share metrics like revenue per share, earnings per share, and free cash flow per share. Now, one of the things I do want to point out about McDonald's, is return on invested capital has been pretty solid over the past few years. 2021, 19%, 22, 17.3, and in 2023, return on invested capital was as high as 26.76%. That's a sign of a quality company. Pretty good for a company that serves burgers. So with all this being said, is McDonald's trading at $250.49 a good price to consider buying in at? And that's what I want to address by jumping into my stock valuation spreadsheet. Come up here, plug in MCD, and hit enter. Now, before we even get into these valuations, I want to look at McDonald's from a historical perspective. If we jump back over to Seeking Alpha, click on valuation, there's a couple of interesting things that I want to point out. First off, price to earnings non-GAAP for the trailing 12 months. for McDonald's is sitting at 20.47, but if you look at the 5-year average, it's 27.75. So this is a 26% difference between the two. McDonald's right now compared to how it's traded over the past 5 years looks like it's about 26% cheaper. Now keep in mind, this isn't technically the best way to judge the actual valuation of the company because earnings can be manipulated, but this is still something to keep in mind, and we can see the same is true for metrics like price to earnings non-GAAP forward-looking and price to earnings GAAP trailing 12 months and forward-looking. All of them are quite a bit lower than McDonald's 5-year average, so pretty interesting perspective. Now, if we jump over to our valuations, there's two that I want to focus on for McDonald's, and the first one is going to be our multiples valuation. The reason I like this one is because it values a company based on how the market is valuing companies that are similar in structure. So you can see we have companies like Domino's, Starbucks Pizza, and Yum Brands. We take their stock price divided by earnings per share to find the price to earnings multiple. We can see Domino's has a price to earnings multiple of 32.3, that's pretty high. Starbucks around 20, Yum Brands 22.74. So the average PE ratio for these companies is sitting at about 25. So if we apply McDonald's earnings per share to this average PE ratio, we come to an intrinsic value of $291.45. Pretty interesting, a little bit higher than that current share price. And if we jump over to the dividend discount model, let's go ahead and zoom out, but this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And like we've already seen, McDonald's from a historical perspective has done a pretty good job of increasing those dividend payouts at around 7% over the past decade. So moving forward, if I assume a dividend growth rate of 6% and a discount rate of 8.5%, we come to a dividend discount model price per share of $283.23. So when we jump over to the output tab, we can see the two valuations that we used here, multiples and dividend discount model, averaged together gives us an intrinsic value of about $287.34, and the current price is sitting at about $250. So it looks like there's around a 13% difference from our intrinsic value calculation to that current share price. So with a 10% margin of safety, looks like McDonald's is barely in our buy range, and with a 20% margin of safety, the acceptable buy price would be around $230 per share. Now I want to be perfectly clear, sentiment is not too good around this stock right now. The economy and inflation is definitely not ideal for this company right now. But with all that being said, based off our projections and how McDonald's is traded historically, it seems to be at a decent value as of right now. So as for me, McDonald's is not a stock I currently own in my portfolio, but I probably will keep it on my watch list and wait to see if it comes even lower. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.